We're focusing on previous day bank liquidity runs, reviewing the daily bias, and I'm referring to a daily chart here. So when we're implementing the daily bias, what we're going to be doing is on the daily chart, we're going to be waiting for a swing high to form and to be broken. This will be bullish. Okay, when we see a swing high broken, in other words, a candle that has a lower high to the left of it and a lower high to the right of it, as seen here. Okay, if at any time in the future it's traded through, when we have that, we have a bullish stage. In other words, we anticipate a future buying opportunity. Doesn't mean to buy it right there. Just means we are now on an alert to wait for a specific criteria. Criteria is going to be looking for a swing low to form down here. Okay, a swing low again is a candle that has a higher low to the left of it and a higher low to the right of it. Again, on the daily chart. Key point here is this swing low should not take out a previous recent swing low. Okay, so if we have this criteria, immediately after a swing high is broken, we have the probable optimal trade entry scenario by itself on a daily chart. Okay, doesn't mean it has to line up with a 62 to 79 tracing level. It just means that we are in effect trading with a higher low after breaking a short-term high. So we have a break in market structure, a retracement, so therefore the market should have an ability to find momentum on the upside. Okay. When the swing low forms, we're going to be anticipating the third candle, that is this one here, its high to be rated or traded through the very next day. So in other words, the next trading day where it opens, preferably you want to see it open below the third candle of the swing low's high. Okay, so here's your criterion. You want to see the swing low form without breaking a previous swing low immediately after a swing high is formed but breaking a previous swing high. Okay, so again, the stage for a bullish scenario is anytime a swing high is broken and traded to a new high, expect a retracement, wait for a daily swing low to form. The swing low should be a higher swing low than any recent previous short-term swing low. The third candle that makes the swing low, that high, you want to see the next candle open below that candle's high, and then anticipate the market to run through this candle's high. We're going to be looking for previous day's highs to be rated each day until a swing high on the daily forms or price reaches a key support or resistance level. And I'll give you an example what that would be. The immediate candle after this particular day's formation, we'd be looking for a bullish scenario, okay, either in the London or the New York scenario, to anticipate a raid on the previous day's high. The very next trading day, we would look for the same scenario again, looking for reasons to be bullish on a retracement lower, going higher, reaching for ultimately to this old high, because this would be an area of resistance, okay, or if it trades to that high and through it, we'd still maintain looking for bullish scenarios, buying, looking for previous day's highs to be taken out, or if we have price rally up to a degree either at this level or before it and creating a swing high. Once that forms, we have to wait for that swing high to be broken on the upside. Okay, we're looking at the cable. This is the daily chart. This scrolled through, just found a random place. It doesn't make a difference where we start at. But I want you to take a look at the price action here. And we're going to look at this swing low right here. And it's on the heels of a previous short-term high Okay, so we have a short-term high here, lower high to the left, lower high to the right, highest high in the middle. It breaks that. Okay, so now we're on a buy watch for scalping. So this is a swing high that's broken, and we have to wait for a swing low to form after this is broken. So we're going to be anticipating a retracement after this run up. So as price starts to drop down, we have a preliminary swing low here. Okay, so this candle, that's the third one. We need to make sure we wait for price to trade through this candle's high. The very next day, it doesn't do that. Okay, then we have another candle form a potential swing low here. So this candle here, we have to wait for this candle's high to be traded through. The very next candle, it doesn't do it. It does it here. So now we can be a buyer here with a scalp running previous day's high, which is this one. Okay, so on July 24th, 2017, that high, again, coming in at 130.57, that's where the liquidity run is going to be right there. This candle on the 25th of July is where we'll be looking for the setup. Right there. Okay, and we're going to drop down into a smaller time frame. We'll use a 15-minute time frame. Okay, and I'll just scrunch this up and put the day dividers in so you guys can see it. So previous day's high is right here. So I'll put a horizontal line on the chart to facilitate that. Okay, so here's where the liquidity is. We're running for 30.57. Okay, this day here, we're looking for a scenario to get long to run that liquidity pool. Okay, and we have this, again, this is the liquidity pool we're reaching for, previous day's high on this trading day. When I use the market sessions, I'm looking for London setups and New York setups primarily. This is a London session low, and I'll let you see that here. That's in London. And we're going to use that, as I mentioned in volume 1. I use session highs and lows. And this is the highest portion of the day in terms of a 15-minute candle. Just put it right here. There you guys can see it. So I'm using this one and this one, framing the entire price move. So as price starts this day here, I'm not concerned about anything until it gets down into the optimal trade entry. 62% retracement level, respectively, 70.5 and 79%. Okay, you can see price trades it, hits it here. This candle comes in exactly 9:45. That's London. And we're going into a nice run into previous day's high. Okay, so you can see that was a nice little scalp. It offered as much as 10, 20, 30, 40 pips to get to the high, and if we look for 10 to 20 pips of a sweep above this high, that takes us 10, 20 here. So 20 pips, 40 pips, 60 pips, 70 pips or so in terms of potential price range. That in itself is it for the week for me. That would be it. I wouldn't need to do anything else. And it's hard to believe, but that's how I operate. I don't look for a whole lot of setups per week because I'm content with doing one thing well, and there it is. Now, if this were a more conservative approach, you could be looking for the long down here based on the optimal trade entry and reaching just to the old high. Now, if that's the case, say you're filled at, we'll just round it to 130.20. That again is getting out at 57. It's 37 pips or so. Okay, almost 40 pips. We'll just say 40 pips. You only need to do one more trade for the week for 10 pips to get a 50 pip net return for the week.